Hello and welcome guys, and welcome to the next session of Valuation. And in this session we are going to start a very interesting topic of our valuation subject, guys. And personally this chapter is my favorite chapter. As far as exams are concerned, this chapter might not hold a great value, might not be repetitive as much as other chapters, but yes, once in a while, after every 2-3 attempts, this chapter finds its place in the examination, in the question paper. And yeah, a question of about 6 marks to 8 marks come in the examination quite often from this particular chapter. But why is this chapter my personal favorite, guys? Because this is the chapter which highlights the prime shortcoming or the prime drawback of our accounting system of not only of India but the entire world. So there's a big lacuna in the accounting system, in the accounting policies, and in the accounting methodologies which are being followed by Indian and other international authorities of accounting. And that lacuna, that problem is definitely faced hands-on by the valuers. We are the valuers, guys, and we are not bound by accounting standards. We are not going to study accounting standards. That is what I told you since the beginning of this particular subject. And we are not bound by any regulations. We are not bound by any accounting methodologies, accounting frameworks. We are not bound by any of those, and we are absolutely free to venture into wherever, whichever field or whichever arena that we want to. And whatever is logical to my mind, whatever is rational to my mind, I am bound to do that, and I am not bound to really do what accounting principles force me to do. So there are a lot of differences between accountants and valuers, and the way accountants approach a particular concept and the way valuers approach a particular concept. There's a lot of difference which is seen in these two approaches, and one of the major approaches from these two angles is of valuation of human resources. So guys, yes, if I talk about assets of a particular company, the accounting standards would lay down the assets like in two categories: tangible assets and intangible assets. Then they would go on to say that asset is a thing that will reap benefit for the organization for a longer period of time than 1 year, and it will reap benefit, it will earn cash flows in future, it will be long term beneficial for the company. Tangible means the asset which we can touch and feel, and intangible means an asset which we cannot touch or feel. And intangible assets constitutes goodwill, copyrights, trademarks, licenses, and what not. There are plethora of intangible assets which are existing with a particular entity, which are to be recognized in the balance sheet. The accounting frameworks are drafted in such a manner that all those tangible or intangible assets can be computed. Their cost can be computed, their value can be computed, their historical cost can be recognized in the books of accounts and has to be recognized in the books of accounts, and then they are depreciated, amortized over a period of time depending upon their estimated useful life, depending upon their benefit that will be derived from them. Maybe the benefit is more than 1 year or less than 1 year. Depending upon that, we recognize the amortization of these particular assets. So yes, this is the long and short of assets which are there in our accounting standards and accounting world, and so be it. But in this entire concept, the accounting world is missing on one highly important aspect, and that aspect is human resources. Guys, I'll give you certain examples. Okay, so if I talk about IT companies, information technology companies, if I talk about consulting companies, consultancy companies, or they're also known as advisory companies, if I talk about all these companies, then there's one common thread which is there in all of these companies, that they are devoid of physical assets. They don't have any physical assets. Oh, sir, are you trying to say that IT company like HP, like Infosys, like any other technological company like Wipro, they don't have assets? This is a fact, guys. They don't have assets. Their buildings are leased. The premises which they are in is a leased premises, so they don't have ownership of that particular premises. The laptops which they use are leased from big laptop companies like Dell, like Lenovo, etc., like any other company. HP is also one of them, which provides them the laptops. And over here, I'm talking about the software wing of HP, not the hardware wing of HP. This is the software wing which deals in softwares. So Infosys also deals in softwares, soft infrastructure. Technological companies like Wipro, they deal in technology. They provide technological solutions to their clients. Talking about advisory or consulting companies like KPMG, Deloitte, PwC, Boston Consulting Group, etc., etc., etc. All these companies provide advisory or consulting services to their clients. Again, same feature. They do not have any assets of their own. They do not have premises by their own name. They don't own any premises in India. They work on leased premises which are leased to them. They temporarily make an arrangement for, say, 10 years or 20 years lease, where they abide, they bind the DLF or real estate owners to agree with them a particular lease which will be unaffected by the inflation rate, and they agree it over a period of time, maybe escalated by some certain amount, certain predetermined amount. And this is how these companies do their business. They don't own anything. Even their laptops which their employees own, because they are not manufacturing anything. They don't have plant and machinery. They don't have any sophisticated equipments or many jazzy plant or some very technically engineered machinery. They don't have any such things. They are absolutely devoid of any such things. They are absolutely devoid of plant and machinery. They don't have any. At the end of the day, maximum to maximum, what do they have? They have laptops of their employees. Their employees are working on their laptops. That's it. They have tabs. They have mobile phones. They have internet connection, high-speed internet connection. They have mobile phone, tabs, iPads, laptops, highly technical laptops. Yes, their laptops are their basically the only asset. There's no other asset. Laptop. How much does a laptop costs you? 40,000 rupees? 50,000 rupees? If you take a higher version, maximum a lakh of rupees? That's it. This is what they have as their assets. And this is what they have as their assets. So now the moot point is, if I'm valuing these particular companies and if I look at their asset base, would I conclude that these companies hold no value as compared to the companies who have big setups, big infrastructure, big plant and machinery? They hold no value in market in place of in front of those companies which are manufacturing companies, which are providing certain high-end services like telecom industry or something like that. They don't stand anywhere in front of those companies. Do I conclude like that? Logically, answer is a big no. Of course not, sir. Sir, what is the starking difference between the way these companies earn their money, both these segments, and versus those companies who earn their money using plant and machinery? So now I am comparing these two set of companies with production companies or a highly sophisticated manufacturing industry like, say, Reliance. What is the difference? Tata's. What is the difference? Difference is Reliance owns several crores of land, plants, technical, highly sophisticated machinery which they've imported from around the world to manufacture yarn, cloth, anything, fiber. However, they don't have any such highly technological, highly sophisticated plant and machinery, highly equipped tools. They don't have anything of this sort. Then, sir, how do they survive? What is their USP? How do they value add to the customer's business? What is the service or what is the product which they are offering to the customers? What is it? Guys, the product which these companies are offering to the customers is intellectual property. Yes. And where is this intellectual property located? Inside minds of their human capital, inside minds of their people. Yes, there is located, that is the biggest asset which these companies own. Guys, these companies, all the consulting and advisory companies, have got the sharpest minds in India. The pure technical and highly sophisticated minds. Yes, they don't have sophisticated machinery, but they have sophisticated minds. They don't have highly technical machineries, but they have highly technical people. If you ask these people to revamp your business, to restructure them in a way that you yield more profit, to control cost, to control taxation, to do audit in an efficient manner so that audit can reap maximum benefit to the client, to restructure their company's processes in a way that processes most efficiently done or most efficiently run, then you approach these companies. And that is the way they value add to your business. They add value to your business. Yes, they don't have any product, but their advice, their consultancy, their opinion to you is their product to you. That is how they produce, and that is how they make value. So if that is the situation, then what do you think is their biggest assets? Guys, their biggest assets is the brains of the human capital, the brains of the people who are employed by these companies. And those people are employed on salaries of several lakhs and even crore of rupees. They are highly paid people who are technically so sound, who are technically so perfect, who are technically so robust in their thinking that they add value to the client's business. They help client saves crores and crores of rupees, and in turn, client pays them heavy fees. Whether in respect of taxation, direct taxation, GST, whether in respect of technological consultancy, whether in respect of process-based consultancy, whether in respect of financial consultancy. If I want to buy back shares, then what should be the legal process as per the Companies Act? Please approach them and they will guide you thoroughly and properly. They have a network of amazing professionals across the globe. So if you want to know what are the laws of US regarding a particular transaction which is happening between US and India, approach them. Approach KPMG, and KPMG will touch base with their US folks, with their US counterparts, and they will tell you the exact implication of a particular transaction which is happening between US and Indian company. Approach them. They have such high technical prowess. That is the quality of these firms. Now the question arises, so we know that this is the asset which these firms has. So you know that these are the assets which these firms has. But sir, the moment someone sees their balance sheet, the moment they see their black and white financial statements which is written on paper, which is typed on paper, they are devoid of any assets. And this is where we valuers differ from the accountants. Accountants, or the accounting world, the accounting standards do not pay any heed to this intellectual property, which is the strongest intangible asset of certain class of companies. Even a company which is a production industry or a manufacturing industry is developed in such a way that they also have some bit of intellectual property in them. But yes, as per the accounting norms, as per the accounting rules, all these things are conveniently ignored. This is how our accounting differs from valuation. We valuers look value in this particular area. We find value in this particular area. We find value in our human resources. I'm not saying that they don't find value in their human resources, but their accountants don't find value in their human resources. Their accountants force them to prepare a balance sheet which is devoid of any asset known as human resource asset. They are devoid of any such asset. Their accountants don't permit. And this is not the story of only Indian subcontinent or Asian subcontinent. Guys, this story is existing in the entire world. Human resources are seldom recognized as an assets in balance sheet. They don't have policies to value and to consider human resources as their assets. They do not have any policy. So what can we do? Nothing can be done. Unfortunately, this lacuna or this loophole in accountancy is definitely not stopping us, the accountants, the valuers, to value human resource. So in this chapter, our entire focus will be to value human resources, to see what is the potential in our human resources, to see how will our human resources progress in future, to see what is the capability of our human resources to earn revenue for us, to see what value would our human resources bring to us. Based on that, we will value human resources. So, but the question is, what will you do with such value when the value would not find a place in balance sheet, the value would not find a place in financial statements? What will you do of such value? Guys, we can at least bare minimum. Yes, I agree. We would not find place in balance sheet. We would not find place in notes to accounts. We would not find any place in any footnote of our financial statements or annual report. But at least bare minimum, what we can do is we can value our human resources and put a small note in the notes to accounts. Notes to accounts is an open document where double accounting system is not required to be made. Notes to accounts can be a simple one-liner comment. We can by that comment recognize or disclose that our human resource value is so and so. We have valued it. So what is the use of that also? Who is looking for it? Guys, PE investors are looking for it. Anyone who's going to infuse their money in your business, any investor who's going to buy your shares will definitely find value in it. He will be amazed to see this fact that company devoid of any assets has several thousand crores of human resource assets. They will be amazed and they will be interested in investing in your business. So from purely a transaction point of view, from image point of view, from corporate transactions, from PE, private equity investing point of view, I guess this disclosure holds merit. So what if accounting doesn't allow us to do anything? It's okay. We are not, as a valuation expert, we are not bound by accounting, but we can anytime disclose this particular value in our notes to accounts. Plus, the day we will sell our company to a potential buyer, there we have to value our human resources because we have nothing else. There's nothing in our balance sheet that is valuable. We have no assets. We have leases. Lease is a liability. We have leases, we have laptop leases, we have premises leases, we have all the expenses which are running, overheads of running these big white elephants. We have only expenses and liability. That's it. We don't have anything. So tomorrow if I want to sell my business, a business which belongs to this sector, information technology sector, or this sector, consulting and advising sector, guys, at that point in time, I definitely need this particular asset value known as human resources. I need that value. And that value will be derived from valuation, because accounting standards do not have any such provision or any such concepts whereby we can value our human resources. They don't have. They are devoid of this concept. So now I am going to tell you about a transaction, and I'm just taking an example where I'm trying to explain you how does it actually work. Okay, so there is an Indian company. Indian company has two divisions. First is product division. Second is after sales services, troubleshooting. So the product division is engaged with making or manufacturing the product, and the troubleshooting division has got highly technically sound engineers who are there to provide services to the people who are buying this product. So I have a company, Indian company, which has two divisions: product manufacturing division and after sales services division, or the troubleshooting division. Now these two divisions operate independently to each other. So there I have a very big manufacturing setup whereby I am having plant and machinery to manufacture the product, quality control, logistics, everything is arranged in this particular segment, which is the product segment, and this segment belongs to after sales services segment, which is there only we don't have any premises, we don't have any infrastructure for this particular segment. Only a small office is taken, and over there calling people are taken, and with calling people, there are engineers, there are experts who solves problem of the product purchasers or the clients. They are just technical people. That's it. We have two divisions. Indian company. Now, Indian company is also having a subsidiary company. However, subsidiary company doesn't have any function as of now. They don't have any running functions. ICO has just created a subsidiary so that if tomorrow we need something, we can use the subsidiary for. So till now, this subsidiary was not in use. So now what ICO thought was that why shouldn't I transfer this division to my subsidiary company? I should transfer this division to my subsidiary company. What will be the benefit which will be derived by ICO? ICO can focus on manufacturing of the product, and subsidiary can focus on the after sales services. That is the benefit which will be derived by ICO by incorporating the ESCO. This is how our operations would be restructured. Subsidiary company was like, okay, fine, that's perfectly fine. Anyways, I don't have any major portfolio. But now the question was that all the assets would be transferred from the ICO to the ESCO. But what will ESCO pay to ICO? Obviously, the purchase consideration, maybe in cash or in bank. Now the question was, what are the assets of this after sales services or troubleshooting department? Guys, the only assets which they owned was laptops. That's it. They didn't have anything else. Obviously, this department was located in rented premises, not even owned premises, rented premises. Their furniture was also rented. Their everything else, every service was rented. So there was nothing of their own. They only had one thing in their hands, which were laptops. And guys, the accumulated value of the laptops was say 10 lakh rupees. Accumulated value of the laptops is 10 lakh rupees. Now, the purchase consideration which was determined for making this transfer was 50 lakh rupees. Oh, sir, for things worth 10 lakh, why would someone pay 50 lakhs? Why would someone pay a premium of 40 lakh rupees to buy something as minuscule as laptops of a particular company? Why would this happen? Why would they pay 40 lakhs of premium for purchasing just laptops, and that too old laptops of a particular company? Because guys, the laptops were not the only assets which are being transferred. One more asset, and very, very critical asset which was being transferred, were the human resources. Unfortunately, in the balance sheet, there was no value for these human resources. For laptops, there was value, 10 lakh rupees, but for human resources, there was no value. What should be done under such scenario? Guys, HR, human resources, the engagement letters or the appointment letters of human resources of ICO were terminated and they were assigned to ESCO. This is the transaction which happened. And for transferring such high intellectually smart people, for transferring these people, ICO demanded 40 lakh rupees from ESCO. I know they are both of the same group, but still the consideration can be at arm's length price, and the consideration should be at arm's length price, and the consideration or the deal should be fair to both the parties. If ICO is sacrificing something, he should get in return the exact purchase consideration. ICO said the purchase consideration was rupees 40 lakhs for human resources, 10 lakhs for laptops, total 50 lakhs. Now the biggest question which this entity faced after this transaction was finalized, this entire thing was finalized, cash was given, or the bank check was given to ICO worth rupees 50 lakhs. All the laptops were transferred in the name of ESCO. 10 lakh rupees was given for laptops, 40 lakhs for the human resources. All the appointment letters were transferred from ICO's name to ESCO's name for the employees who were engaged in after sales services department. Everything was done. Now the moot question which was to be determined was, what is the accounting entry which we should put in the books of accounts of ESCO? What is the accounting entry? So I'll try and draft an accounting entry in the books of ESCO. You will help me with this accounting entry. Okay, sir, sure. So first of all, I am just crediting the cash or bank balance worth rupees 50 lakh. We have shelled out 50 lakh rupees to cash and bank. What have we received? So we have received laptops. What is the worth of laptops? Laptops worth is 10 lakh rupees. Unfortunately, this transaction is incomplete. Since this transaction is incomplete, we need to complete the transaction. We need to have one more debit figure which should be worth 40 lakhs to complete this accounting entry. Now the question is, what should be that missing figure? What should be that missing account head? You are thinking absolutely right. The missing account head should be human resource assets. Guys, but unfortunately, there is nothing called human resource assets in our accounting standards. Hence, the only option left was to recognize this part as goodwill. Because accounting standards don't have human resource asset. All they have as the residuary figure, which is again wrong. You cannot have a residuary figure which is value of something, which is wrong. And we'll take up this point in detail in our goodwill chapter. When we'll start goodwill, we'll take this particular point in great detail. We'll talk about it. Right now, I want you to just know that saying anything and everything as goodwill is unfair. This is not goodwill. This is pure human resource asset, which is to be recognized in the books of accounts. Unfortunately, we do not have any such concept called human resource asset in our books of accounts. That's why we are forced to debit an account called goodwill, which is an arbitrary act. But guys, in such a situation, whatever be the accounting entry, at least me and you who are valuers, who will be the valuation experts, who will be not bound by any accounting standard or any law of land, we know that this asset is not goodwill. This asset is human resource asset and it should be valued properly. So to value this asset in any transaction, we have human resource accounting or valuation of human resources. Yes, this topic is little new to the accountant world. They are not able to digest it properly, but so may it be. I mean, I don't bother, I don't care about it. Let it be. I am a valuer. I will value my human resources the way I want to value them. That's it. Yes, so this is the genesis of the chapter which we are going to start today, and that is why I was telling you in the beginning of the chapter that this is something which is really different from what you've been studying in your accounts, what you've been studying in your normal course, normal routine, and this is how valuation becomes a little different from this particular world, which is the accounting world. So while valuing human resources, I will definitely take a toll on certain accounting concepts. I will modulate them, I will rotate them, I will twist them, and I will reform them, rejuggle them. I will again juggle up your accounting knowledge, and I will reframe your entire accounting knowledge while doing this particular chapter. So let's come to the point now. Sir, we understood all your point. We understood about the variability which is existing in Indian laws and international laws about the human resource accounting. We understand all that stuff. Now, sir, the moot point which is running through our mind is, sir, how do you value a human being? I mean, how funny does it sound that there's a human being standing in front of you and you're saying, oh, what's your value? Just like we, to ridicule someone, we tell that person, what's your value? What's your worth? Now that ridicule that ridicule which we sometimes do of the other person, we need to really have that ridicule and apply that ridicule over here, and we need to assess value of a particular person using certain methodologies which are prescribed under the valuation world. And I will also make you criticize certain policies. Certain methods are really criticizable, they are not worth it, and I will make you appreciate certain principles which are really worth it. So primarily there are two principles which govern human resource accounting, which governs valuation of human resources. Guys, principle number one, historical cost method. Just like when you purchase an asset, you spend some amount on that asset, and that amount becomes value of that particular asset in your balance sheet. Historical cost method. So when you buy a particular asset, what do? Sir, the purchase cost of the asset plus all the expenses which are incurred to bring the assets to its current use. The moment of capitalization, the amount of capitalization will be equal to the purchase cost of the asset plus all the subsidiary expenditures which have been incurred for bringing that asset to the current use. So for example, if I bought an AC, then the installation cost of the AC, the carriage inward of the AC, everything will be added to the cost of AC, and it will be capitalized in my books of accounts. And then I will depreciate or amortize that particular AC in number of years in which I'm expecting its use, estimated useful life. I will divide it amongst the number of years. Yes, this is the way we value or we recognize our assets in our books of accounts as per the accounting standards. Similar is the way of recognizing human resource accounting or value human resources in valuation. The method number one is historical cost concept. So the method is really simple, guys. Whatever expenditure you incur for bringing the human resource to their present use. Sir, what is the expenditure which we are incurring for bringing the human resource to their present use? Sir, they come on their own. They pay the fare of cab or taxi for coming to office when they are interviewed. So they are interviewed, they are selected, they are given the offer letter. Then they come to the organization and they pay their cab, factory, taxi fare, auto fare themselves. We don't pay anything. No. Soon as they are inside your factory, you incur a significant expenditure on them before you send them to the floor. Please think, what is that expenditure? Yes, that expenditure is recruitment expenses. So whatever expenses you have incurred for recruiting a particular human resource, you should not put them in P&L account. Oh, so but those recruitment expenses are in the nature of revenue expenditure. Absolutely. From an accounting standpoint, now I'm asking you to tell me what is the valuation standpoint. From an accounting standpoint, you are absolutely right that they should be charged off in P&L account as revenue expenditure. But from standpoint of human resource valuation, is that expenditure revenue or capital? Sir, we don't know what you are saying. I am saying exactly the opposite concepts of what you've been taught in accounts. Guys, accounts have always taught you that all the recruitment expenses, all the training expenses of the employee should be put to P&L account. I'm just asking you to do one thing. Pull them out of the P&L account and capitalize them. That is the value of a particular human resource asset. And this method is known as historical cost method, whereby instead of writing off the expenditure incurred on bringing the employee to its current location and current use, instead of writing off that entire expenditure, what we do is we capitalize it in our books of accounts, and then we amortize or depreciate it the way you do your the way you depreciate your assets. We just depreciate it in the similar fashion. This is the first method which is used for valuing the human resources, which is known as historical cost method.